everyone out there is talking about stocks. Whether it's to pick your own stocks or pick your own ETFs, broadly diversified, whatever, it's always this element of stocks. And probably so because, they do provide the best returns over an extended period of time, right? Based on history. I'm not saying that it will continue to be this way, but based on history, they have provided very good returns over an extended period of time. But what about bonds? Bonds seem like this sidekick, like Batman and Robin Hood. And Robin Hood somehow comes out, because Batman must have a sidekick like that, right? But actually, bonds is very interesting in itself. They have a very different way of making money. How do you pick your own bond fund? How do bonds actually make money? Can you actually make money in the current bond environment, where there's a lot of negative yield? So that's what we're going to talk about today. Welcome to another Chills with TFC session, and in this series we hope to bring on interesting, relevant people to help us learn better from various perspectives. Life is not always about learning from people that you already agree with. Perspectives shape a rounder thinker. So in our pursuit of the life we love or managing our finances well, our guest for today is someone that's leading the charge in the local financial social enterprise space. She has a lot more up her sleeves. It is not all about holistic financial planning, broadly diversified, all the kind of rinse and repeat financial advice. We are going to go into her first love today, bonds. She was in the heat of it all during the 2008 mortgage bond meltdown, right? Dawning with her all these experiences and battle scars from the market. Let's welcome CEO of MoneyOwl, Chuin Ting.
Hi everyone. Hi Reggie. Thanks for having me on the show.
When we're talking about investing, a lot of people will look at stocks, right? But today we want to spend a lot more time to talk about bonds, right? Because it's the not so sexy one, right? For like a better way to put it.
Bonds are my first love, actually. Because of where I came from.
And that's why we are here with you. Help us understand what are bonds. Is it the same as like loans, like what we understand, as retail individuals?
So bonds and loans are similar in that they are both borrowings. So meaning that someone lends someone else or an entity a sum of money for a time and then expects to get it back with a certain compensation. But there are some important structural differences, I would say. And I think I would like to divide that into like 4 differences. First is who borrows. Second is who lends in a bond versus a loan. And third is how you repay, the structure of payment. And fourth is the concept of price. So firstly, who borrows? When it comes to loans, generally speaking, it's individuals. Like we borrow to buy a house or we borrow a credit card, etc. Not a good idea. And corporates, right? Companies. Of course, governments do sometimes borrow from, say, World Bank or whatever, but let's exclude them for now. So loans, individuals, corporates. Bonds, governments, and corporates. Then who lends? Who's the lender, right? Who's on the other side? When it's loans, it tends to be from banks, right? And but when it comes to bonds, the lender is actually capital markets, right? The capital market participants, or you call them investors. Now, this is important because the source of funds is different. When you issue to the capital market, the market determines whether it wants to lend to you, how much it wants to lend to you, and then the price at which it wants to lend to you. And it's a collective assessment of pricing your risk. So in a sense, you can say it's a market discovery of your creditworthiness. But when you borrow from a bank, yes, the bank will also make the assessment, but the bank has to use its own balance sheet to support it. Now, what do I mean? Because in the government regulations to promote the stability of bank, you cannot lend out all your money, right? You need to set aside some capital in order to support potential losses from your book. So what this means is that when you have to set aside capital that cannot be used, it actually becomes costly for bank shareholders. Right? So there is then that difference. So this is really about who lends. Right? So loans are from banks. And I would say that generally speaking, if you're very confident of your position in the market and you have a sound business, if you issue a bond, that market discovery process should reward you with slightly lower rates. That's what I believe so. But there is, because of regulations of bank capital and all that, in Europe, corporates tend to borrow more from banks, and say in US, they tend to issue bonds rather than borrow from banks. So there are structural differences here. Yeah. So who borrows and who lends, those are differences. Now, how you repay is also different from how we understand it. And this is quite important because when you have a loan, it tends to be a term loan for a time. And as individuals, we are familiar with amortizing loans, right? You pay some principal and some interest. The periodic payments are level. So like your monthly mortgage is the same amount, but the proportion that goes to its principal and proportion that goes to its interest is different. But over time, then it falls to zero, right? You have fully repaid. Now, bonds are not like that. So bonds, what you lend at the beginning, you repay at the end, and in between you pay coupon. Usually semi-annually, meaning every 6 months, but sometimes annually. So this is the payment structure that is quite different, and it does affect the way that it's priced because it depends on when you're buying the bond, right? You have a different risk because your risk is at the back. So the interesting thing though is that you can turn a loan into a security like a bond through a process called securitization. And this is again what happens in mortgage-backed securities. So you take basically, let's say 100 mortgages and then you package into a bond. And then you have a certain cash flow and all that you pass on. So, but anyway, generally speaking, nowadays we tend to be a little bit less, into this structural thing. So a bond has that coupon and then a big principal at the end, generally speaking, for vanilla bonds. Now, finally, this concept of price. How do you price a loan? When you think about a price of a loan, actually, most of the time you're like, what are you talking about? You're talking about interest rate, right? So you say mortgage rate is what? Or you say your company, you're borrowing, you had to borrow 10% or 3% or what. So this is what it is. It's basically an interest rate. But when it comes to bonds, the concept is basically yield. Right? Yield, and the inverse of yield is price. But yield, maybe I just quickly explain, is not really the same as an interest rate or the coupon that you get, which I described just now. So let's just say that you bought a bond and it pays once a year coupon, and it's a 1.2% coupon. And the bond is issued at $100 par value, and at the end of 1 year, you get back $100, right? So in this case, your coupon is 1.2%, and your yield is also 1.2%.
Okay. Yes.
But let's say you bought the bond not at $100, but you bought at $120. So you bought higher than par, which we call premium. So you bought $120. At the end of 1 year, you have gotten $1.20, and then $100, right? So then what is your yield?
Lost, right?
Right, yeah, it's actually lower, right? So it's actually more than 1%, right? Because you actually paid more for it. Yeah. So what this means is that you can have two bonds of the same maturity that can have a different coupon, but yet the same yield. And this is then because of the price. So generally speaking, for bonds, when yields go up, the price of the bond has fallen, right? Because it's not equivalent to the coupon. And this is where the capital markets come in, because you price according to yield, and how some of these prices are affected is in the buying price of the bond. So a company come out and say, I'm going to issue this amount of bonds. The market determines where you strike final yield. So if there's a lot of demand, then you tend to be able to issue at a discount. So that's good. That means that markets still have that confidence in the company.
So how does that discount then reflect on the price?
So let's say you have a par value of, say, 100.
So that is the issue price?
No, that is just the value of the bond. It tends to be, they say, 100 or so. So it's issued at 98.7 cents, for example, right? But because at the end, you get back 100. Usually that's how it is. So then you do the calculations in between to get the discount rate that will bring all the cash flows to that price of 98.7, and then you know that what is that yield. So if that was a 3.5% bond, it means 3.5% coupon, but because it's issued at 98.7, the yield is higher than 3.5%.
Because at the end of the term, you actually make that
100.
The 100, right? Which is about another 1.3% more.
That's right. Yeah.
1.3 times more, not 1.3.
Yeah, you have to sort of do the discounting, the different periods.
Yes. Okay.
But this is how negative yields come about.
Yeah. How do people make money in a negative yield environment?
We can talk about that a little bit more, but how do you even sort of operationalize a negative yielding bond, right? So what happens is that it's not that they pay you money for lending them money, like the German government now is having negative yielding bonds. What they do is that they issue zero coupon bonds. So zero coupon bonds, generally speaking, means that they should be issued at a discount. So the 98.7 at the end is 100, and that difference actually, then you make your calculations, implies a certain yield. In between, you don't get coupons. So this is a zero coupon bond. So, but in this case, when a negative yielding bond, instead of issuing at a discount and then you get back par, they issue above par and then you get back 100. Yeah, so that's how the negative yield comes about.
Yes.
Yeah.
So essentially, they're not going to give you any money for holding on to the bond through this process, because that's why it's called zero coupon, right? And then for something that is worth 100 at the end of the time period, they sell you at like 110, 120, something like that. Right?
Yes, that's right.
But isn't that there's a market mechanism behind this, right? How is that 110 or 120 priced?
Okay. So there's a primary market for bonds and a secondary market for bonds. So for the primary market is really when in this case, the government will issue, and then they will announce auctions, and then all the dealers will come and they will buy the bonds, and because there's a lot of demand, they will bid up the bonds. So this means that for some reason, the confidence, perhaps be it in the banking system or be it in the economy, is so low. Everyone wants to park their money into a very, very safe instruments, to the extent that they are willing to lend the German government money and pay for the privilege of lending. Right. Yeah. So that's how negative yielding bonds come about. It's quite interesting. It's an interesting
phenomenon, right?
That's right. Yeah.
So essentially, it means that the guys, they don't want to put their money elsewhere. They're willing to fight for giving the money to the government.
Yeah,
right? That's why the bond bids up, and at the end of the time period they lose. And then in between, how do the people that participate in between make money then?
Also, there's a secondary market where people just really buy and sell bonds. So this is usually done through institutions, and so it's quite interesting because we can think about why and how do institutions use bonds, and how do they profit from bonds, or how do they think about bonds.
But like what you rightfully point out, it sounds like this only is an institutional game. Like only the institutions get access to it.
Yes and no, but I would say that one thing that is very true is that it is largely about institutions.
So then how do we retail guys participate in the bond space?
So for us, there are two ways, let's say practically speaking.
Like realistic one.
Yeah, realistic
we
one.
Actually can do it.
Can do it. Without like having to be a
don't have to
bank
register.
One is you can buy some that are listed, right? But most bonds are actually in big denominations of like 250,000 Singapore dollars, for example, or 100,000.
So although they are listed, I can buy directly, but the minimum ticket is 250,000.
Yes, that's right. It tends to be.
不可以啦.
Okay, unless you're an accredited investor or you have,
yes.
there is this. Like iFast has this service called Bond Express, but for accredited investors only, where they can buy in odd lots. So accredited investors have a certain net worth or certain income, all that. For retail bonds, there have been as well, and some of them are also listed, but there are not many. Right? And the higher quality ones would be the Temasek bonds and also Astria, which also issued which is a securitized instrument on underlying of private equity instruments. So they use a bit of that technology of structuring, but this is backed by Temasek. And so I think people have more confidence in that. So if you look for CDP, I think there are probably only about 8 retail bonds right now. So SIA also has a retail bond. I think Fraser's has a retail bond, but not many. The one retail bond that in recent times has not sent this retail bond reputation down is, of course, high flux, right? So the problem with bonds for retail investors is sometimes they are sold as bonds equals safe. Right, and
that's what people say.
That's right, So
bonds equals safe, yes.
Yeah, but it's not necessarily so, as we can say, just because something carries the word bonds. And so in the case of high flux, it was actually a perpetual bond. So a perpetual bond is different from a senior unsecured bond. Right? So and it's different than from a subordinated bond. And this is to do with the capital structure of a company. So to understand bonds again, you remember it is actually a borrowing. Now as a company, when you borrow, or even as a country, when you borrow, you have an obligation to pay the interest. And as a company, before you pay your shareholders, you have to pay your interest and your borrowings.
Yes.
Right? It's the same as us, right? We have
Yes.
when we borrow from bank, we have to pay
You pay your
liability.
your debtors first.
That's
Yes.
right. So if anything happens, we sell off our assets, we pay the debtors first. And so then bonds in itself, you can have a hierarchy of bonds. You can have secured bonds, right? And that means that is secured on something. So let's say we have the mortgage bonds were secured on a pool of mortgages. So the company can collateralize basically their borrowing. Most common is actually a senior unsecured bond. So it depends on the cash flows of the company to pay you. And senior bonds is where you usually take the bond rating of the company rating from. So there's senior bonds, then there's subordinated bonds, and then there are things called perpetual bonds. Now bonds are meant to have a term, right? But when they're perpetual, then it becomes a little bit more like perpetual capital, which is actually more quasi-equity. So in the perpetual bonds, you are lower down on the capital structure. You get a high coupon, so the high flux at 6% coupon. Right? But what it means is that something happens to high flux, your priority of payment is way down. So it depends on how much net worth there is or net equity there is in the company. How perpetual bonds work usually is that there's a call date, such that you won't always be holding on to a bond. At some point, they will call it back, and this is how it works. So I think many retail investors did not understand what a perpetual bond was. The perpetual bond actually lower down on the capital structure, and I guess they also felt that high flux is like a Singapore darling.
Like everybody needs to drink water, right?
That's right. That's right. So it's very sad because when bonds are sort of misused, right? In the sense, and I'm sure they have been sold these things, saying that bonds very safe one,
Confirm. I hear this all the time.
And then you got people putting their life savings into
Yes.
It's really sad. So generally speaking, it's very hard for retail investors to access a basket of bonds. And at MoneyOwl, we feel that bonds, like equities, we should be globally diversified, and we want bonds to be really performing their function of being the safer asset, right? So how do bonds actually feature in this whole return and risk spectrum?
Yes.
Maybe we can talk a bit about that.
Now share with us. Yes.
I
want to know. Yes.
So bonds return more than cash, but are more volatile than cash. So a little bit riskier than cash. But they return lower than equities and are less volatile than equities. So this is roughly where they are. So because otherwise, if it's just for safety, right, then why don't you use cash? Because cash don't return you anything. Right,
nowadays.
Especially nowadays.
More cash, right? It's like every bank is cutting their, fixed D rates and everything. Right?
That's right. And why is that? Let's say compare equities. Why is that so? Remember I said it's higher up in the capital structure. So it means in return for that safety of being paid first before the shareholders, you don't get any upside. So the best you can get in a bond is your principal back and whatever coupon or yield on the bond. Right? As a bondholder directly. I'm not talking about the trading of bonds yet and all that.
Yes.
Yeah. So return is lower than equities, higher than cash. Volatility is lower, actually much lower than equities, but higher than cash. So I was just looking at some data. So let's say the US dollar version of our Dimensional Global Core Equity Fund, which we have in our portfolios, over a 10-year period, returned about 8.9% per annum.
Wow.
To the return.
That's pretty high.
But the standard deviation, which is volatility, is 14.7%. Okay. So how do you understand this? Is that within one standard deviation, it means that 68% of the time, you will be, say, that average return minus 14.7% or plus 14.7%. So you have that variability, right? So that's usually a measure of risk, volatility. So 8.9 return versus 14.7 standard deviation. Now, if you look at, say, the Bloomberg Barclays Global Aggregate Bond Index, that's US dollar hedged, it returns around slightly less than half over 10 years, 4.2%. But the volatility is only 2.6%.
Ah,
So
okay.
that's the difference, because it's so much less volatile. And I don't think I need to talk about cash. Price shares of only 1% and volatility like 0. Whatever.
Yeah.
Then the thing is, but why doesn't everyone just invest in equities? Right? It's because of this volatility.
Yes.
Then you say, should I then maximize risk-adjusted return? So risk-adjusted return, you will hear a lot of fund managers say that, return versus risk, Sharpe ratios and all that, right? This boils down to whether 4% is good enough for you. Right? Over the long term, does it beat inflation? Does it meet your needs? After inflation, does it meet your, your life needs that I was talking about? Is it sufficient returns for you? And for most people, it probably would not be, because we want to increase. We have so many needs, right? We need to save for.
Yes.
Yeah. So this is the nuance there. That yes, equities will give a higher return, but we don't all go for equities. And just now we talked about how institutions use bonds, right? Or we referred to that about institutions buying a lot of bonds. And this is one of the things about institutional investors, say like, the foundation that I came from, that institutional investors, very seldom have I seen a mandate that 100% equities. Because it is always about the risk appetite. And because bonds have this lower volatility, they have that function of dampening volatility of the whole portfolio return, but better than cash, because cash will give 0, but this one will give a little bit. And there's also some negative correlation, not always, some negative correlation between bonds and equities, because when times are stressed, investors tend to run to safety, or they just want to get a little bit of return but not 0, so they will then bid out all the prices of the bonds. So that correlation, but not always perfect, helps in the whole portfolio volatility.
Essentially, when the stock market is shaking, then the bond market will come in and
That's
help
right.
you stabilize your portfolio.
Yeah. And this has to do with the business cycle and all that. So all institutional investors have a risk appetite, and usually it's stated down in a policy, what you call an IPS, or a investment policy statement. And it's not that different from how we advise our retail clients. It's around 3 things. It's your need, ability, and willingness to take risk. Your need to take risk is actually what return you require. So if you are like a foundation, you might have a spending rule. You might have, say, I'm looking for how much return from this because I need to spend it on this and that. So like endowments, for example, they have this required return. So for us, it is like, how much return do you need in order to retire, right? So that's the need to take risk. If the need is very low, then
then why you need the fluctuation, right?
Don't take risk. Yeah. Then the other is your ability. So this ability for us as individuals is the time horizon, because over time we know that the stock market will go up, but then you can ride out the volatility. But if you only have 2 years left, and say it was 2006, right?
Just sway that year is your year.
Correct. And then you needed to take out some people in the US, they needed to convert their pension into annuity in 2008. Well, then it was down by 50%. So 2 years means you have very, very low ability to take risk. For institutions, it's to do with, are these surplus funds, are these this working capital that I need, or is it really, what can I do with this amount of money? Do I need it at all? And also the cash flow management. And the last is your willingness to take risk, your tolerance. Right? So if you tend to be, say, a government-linked body or something, then you might not want to, expose yourself to a lot of questions if the
like this year do very well, down, next year why so bad, like that, right?
Do very well is okay, it's always the down. Yeah. So if you see, let's say our GIC, right, there's a reference portfolio. It's not really a bench, but the reference portfolio for the long-term investment, 65% equities and 35% bonds. So this is an asset allocation. So what happens then is all your risk appetite translates then into an asset allocation, and the bonds are a staple in this asset allocation.
Okay, so then, like just now you point out, right, fundamentally the standard deviation is the risk factor, in this whole thing. And when people go into bonds, essentially you want to get something that's lower SD, like lower standard deviation, and then exchange the upside for the stability, right? For like a better way to put it, that is what it is. Then from a bond perspective, right, like from what I understand, it's like there is the whole like grading process, like you rate the bonds, right? So how do they rate the bonds, and at what point do they go from like investment grade to like junk grade?
Okay, so there are 3 rating agencies.
Only 3, yeah.
There are more, but
Okay,
the sort of
reliable
respected ones.
Big three,
big three. Yes, S&P or Standard & Poor's, Moody's, and Fitch ratings. Right. So there are a few others, and then China has one and all that. But the 2 among the 3 that are bigger is S&P and Moody's. So they have a scale that goes from AAA down to D. What do these grades reflect? They reflect ultimately your ability to meet your obligations. And the ability to meet obligations actually, I'm just wondering whether I should say ability, because there's actually 2 main components: is your ability to pay and your willingness to pay.
Yes, fair.
Because some companies are very 超看, they can pay but they don't want to pay, right? And this actually happens, or some countries even. There are some countries that are serial defaulters, like Argentina. But people still go and buy, right? And all that. So this is roughly what happens. And how do rating agencies rate these bonds? They have a sort of set of metrics that has to do with leverage, so how much debt you have, but a lot of cash flow things, how much interest coverage you have, how many years can you continue paying, how many maturities you have, and then whether you can refinance them. If you have some extraordinary support because you are a government-linked company and all that, then you might get an uplift, right?
Extraordinary.
Yeah, correct. Extraordinary.
You special kid. You are a special kid now.
Yes, that's right. Yeah. So I remember the last time we had Neptune Orient lines. So NOL, actually on the metrics not looking so good, and also profitability and all that. But because they were Temasek portfolio companies, so I think the investors also gave them that uplift, and I believe their ratings also benefited. In Singapore, you may not find that these ratings are common, right? So what it means, the reason is because when you go out to issue bonds, you want to use the rating to give a handle to your investors so that the investors will price you in accordance with this rating service. So there is inherent there a little bit of conflict of interest, right? And this is what happened during the 2008 crisis as well. So I want to issue a bond, and I pay you to make the rating on me.
So you give me a better rating.
Yeah,
and then
okay, yeah. So obviously, so there's actually lawsuits filed over these things and all that, right? There's that conflict of interest inherent there in this rating. But generally speaking, they look at certain credit metrics. I think besides the problem of the conflict of interest, the issue which actually put the credibility of the rating agencies into doubt when the credit crisis hit, or when the financial crisis hit, is really that the rating agencies get it wrong, or they got it wrong, especially during the crisis. I still remember in 2007, and I kept that rating report for a while. There was a bunch of bond insurers in the US, and their names like MBIA, MBAC, FIGIC. And what they did was they guaranteed bonds. And they were given a AAA rating as late as October 2007. But they couldn't fulfill, and they dropped to CCCs and all that, like very, very quickly. So this is really when what's happening there, right? So there's a bit of groupthink and all that. But you also think about how would the rating agency know when your interest coverage is down or that. It's after the fact, right? After you report news. Usually it reports some news, and I guess in the US there's more transparency, so it's a more common reporting.
Yes.
Right? So you say, the results, then usually after the results, the credit analyst will do something. I mean, all of us will also be watching and looking, and then there'll be a downgrade, or maybe an outlook will be issued. But then it's sort of slow, right? So rating agencies are therefore be naturally behind the curve, because it's not fair to their client for them to act for no reason, right? Of course, sometimes it's macro factors affecting that particular outlook. So during COVID, I guess many companies will have had some issues with their ratings. So there is actually an alternative, right, which is to use market prices. So for MoneyOwl, this speaks to us because generally speaking, we believe in the power of the markets, the efficiency of the markets, and bond markets are large, and for starting actually with treasuries, and they are they price, right? So they price the collective and aggregate expectations and all the information available of all the participants in the market. So it is possible to look at where a bond is trading and to then say what does that imply for its credit worthiness. Yeah. So for a government bond, it trades at a certain yield. So at a certain maturity, it might trade, say, let's say US 10-year bond yield is about just over 1%, 1.1%. Now, if you are rated lower than the US government, as most corporates would be, if not all, and then you have a credit spread.
Yes.
Yeah, you need to pay more, right? Because you are not as.
It would be pretty amazing if you are graded higher than that.
Well, generally speaking,
Yes.
if you don't tend to be rated higher than your government, but it has happened before, where let's say, was it Petrobras or something, where you are rated higher than your government because you have more cash flow coming from the outside your country than your government has. So it does happen. Yeah. But generally speaking, yeah. So this is what you call a credit spread. So the wider the credit spread means that the more compensation or the higher your yield is after minusing off the government yield. So you can look at then when the bonds are trading. So remember I told you the prices and it's also the implied yield, and then you can work back that credit spread to see, is this bond actually trading at a triple B or is it actually trading at a double A? So if you then think that actually the market, you should trust market prices more, then you should take your actions actually based on that. Yeah. And during the crisis in 2008, at one point we saw Lehman was still being rated A or A plus, and it was trading at a kind of low triple B. Yeah, then it jumped to default. Yeah, so there's a way of like looking at is there something that someone knows or someone is expecting in the markets. Our dimensional funds also work like that. So they don't just wait for the rating agencies, they look at what is the implied credit worthiness the markets are telling them, right? And then they take the actions accordingly.
So you're using price discovery to then decide how secure these bonds are, essentially.
Basically, price
right?
to
Because the
tell you
market will
something.
tell you, right?
That's
It's
right.
like, this is getting bidded up, then you know something's going on
That's
here.
right.
Okay, so then one last question, okay? So all that being said, now I think I get a better understanding of bonds. I know there's so much more to talk. I think we can see, come back again, right? We'll talk again. But then where does bonds sit in one's overall portfolio then?
Generally speaking, we will not depend on bonds to make you money, right? And where it makes you money is actually in equities. Yeah. So there's a very fundamental economic system reason for this. Remember I said bonds, no upside, right? But equities is when the enterprise of the world, and you grow your products and you have production and all, this is where you are participating in the economic activity of the world, beyond just supplying bond capital. So we would say make your money in equities.
Yes.
But because not all of us can take that roller coaster, right?
Yes.
Yeah. Then if you press the button when you're on the roller coaster, you fall off, you die, right? Figuratively speaking, thankfully roller coasters don't have, because we can say all in one, but it's not easy to stay invested.
Yes.
Your advisor should help you. That's why we are a bionic advisor. Your advisor, who is not a robot, can advise you, please remember, stay invested. But you may not have the risk tolerance. In which case, it's better for you to say not have a 100% equities portfolio, even if you are very young, because if you are going to press that button, then rather you be in a, say, 60% equities with 40% bonds. You still get good return, that's sufficient, but in a way, with the bonds helping you to stay invested by the effect of the portfolio. There's a second use of bonds in a portfolio, which is actually for income. That means to actually clip the coupons and to get some kind of income distribution, right? So even institutions do that, and also including our like GSEs and all that, they give the government some is realized income and some is not. Now, of course, this is really more when you need to withdraw, and the corollary to it will be like dividends, stocks, right? But of course the risk is lower for bonds, and this is one use of bonds. Unfortunately, because of the interest environment now, this coupon don't tend to be very high lah. So it has been coming down. So actually, even for distribution, there are techniques that we can use, such that we use, if you need a certain income amount, you can actually also withdraw from your, say, equities portfolios in a percentage. So some of it can be funded by bonds and some of it a withdrawal from your other investments. Yeah. So, but I think that's probably a topic for another day about how to withdraw.
Awesome. Thank you. I think we all learned a lot of good stuff, right? So thank you for your time. I think we will come back again.
And thank you, Reggie.
Let's spend more time with you. Thank you.
Thanks for having me.
Awesome.
Yeah.
Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated and discussed. Join our community Telegram group, follow us on our social, sign up for our weekly newsletter. Everything is in the description below. And if you love us, want to help us grow, definitely share the podcast with your friends and on your socials. Also, if you have some interesting thoughts to share or know someone that you want to hear more from, reach out to us through hello@thefinancialcoconut.com. With that, have a great day ahead. Stay tuned next week and always remember, personal finance can be chill, clear and sustainable for all. Okay, wow. Hope you learned something interesting from her. She's talked about a lot of stuff, right? From like bond yields to how bonds work. When does a bond go from investment to junk? So all these different elements I think are very important, right? So I hope you be able to get a better understanding, right? Rather than just go into this idea of like, bonds important because you must broadly diversify, right? So that'll be great. And next week we're gonna touch on this very hot topic, right? The whole idea of Bitcoin, right? So we have a guest coming on next week to talk about Bitcoin. His name is Arthur, right, from Defiance Capital, and he actually believes that Bitcoin will go to zero. But what is the future of crypto then, right? Like he's super big on the whole like DeFi, decentralized finance, and I think he has some very good thoughts, and he gave us like a broad understanding, a broad lesson of like what is Bitcoin, what is the crypto market, what are different kind of coins out there, and where does he see the future of the crypto industry, right? So next week, stay tuned. A very, very hot topic of Bitcoin and blockchain. See ya.